Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Optimizer go head-to-head on overpaying your mortgage is the best financial decision most people won't make. Let's get into it.
Every pound you overpay on your mortgage is a guaranteed, risk-free return, and in a world where nothing is certain, that's worth more than people realize.
Guaranteed, sure, but guaranteed to be suboptimal. The UK tax system hands you tools like ISAs, pension relief, and salary sacrifice that can turn the same pound into significantly more over your lifetime.
Can we talk about what a guaranteed actually means, though? If you're on a 5.5% fix, every overpayment saves you 5.5% after tax, no IFS, no buts. Your ISA has to beat that consistently, and the stock market doesn't do consistency.
But you're cherry-picking the worst-case rate. Most people remortgaging now are looking at 4 to 4.5%, and with a base rate at 3.75% and heading lower, that gap between mortgage cost and investment return is only going to widen.
Heading lower is a prediction, not a fact. People said the same thing before rates shot up to 5.25% in 2023. Nobody saw that coming.
Fair, but that actually helps my case. If rates spike again, you want liquidity, money in an ISA you can access, not equity locked inside your house that you'd need to remortgage to touch.
That's the flexibility argument, and I hear it a lot, but let's be honest, most people don't access their ISA in an emergency. They raid their current account or stick it on a credit card. The overpayment enforces discipline.
Discipline is great, but it shouldn't come at the cost of tens of thousands of pounds. If someone puts £500 a month into a pension via salary sacrifice instead of overpaying, they save income tax and national insurance. That's an instant 32% boost for a basic rate taxpayer before any investment growth.
And they can't touch that money until they're 57 at the earliest. For someone in their 30s with a young family, that's not helpful. Being mortgage-free by 50? That changes your entire life.
I'm not saying put it all in a pension. That's why I talk about the optimal split, enough pension contributions to capture employer match and tax relief, ISA for medium-term flexibility, and then overpay with whatever's left.
See, now you're overcomplicating it. The beauty of overpaying is its simplicity. You don't need to pick funds, rebalance, or worry about market timing. You just pay more and your debt shrinks.
A global index tracker in a stocks and shares ISA takes about 10 minutes to set up and you never touch it again. That's not complicated, it's just unfamiliar to people who've been told their mortgage is the enemy.
Let's talk about the psychological side. There is something profoundly freeing about watching your mortgage balance drop faster than scheduled. It changes how you sleep at night.
I don't disagree that it feels good. But feelings aren't a financial strategy. If peace of mind costs you £50,000 over 20 years in lost investment returns, that's an expensive sleeping pill.
50,000 assumes everything goes right, consistent 8% returns, no crashes at the wrong time, no panic selling. The average investor massively underperforms the index because they can't sit still.
And the average overpayer gives up after 18 months because it doesn't feel like it's making a difference on a 25-year mortgage. Behavioral arguments cut both ways.
Actually, that's exactly why I ran the numbers on a real mortgage. On a £200,000 loan at 4.5% over 25 years, overpaying just £300 a month saves you over £45,000 in interest and knocks 7 years off the term. That's tangible.
Now run the same £300 a month in a stocks and shares ISA at a long-run average of 7% after fees. Over those same 25 years, that's north of £240,000, completely tax-free. Even after you pay off the remaining mortgage balance, you're tens of thousands ahead.
If the market delivers 7% annualized over that period. The FTSE 100 has had entire lost decades. Japanese investors are still waiting after 35 years.
Which is why you diversify globally, not just UK equities. A global tracker has never delivered a negative return over any 20-year rolling period in history.
Past performance, as they love to print on every fund fact sheet. Look, I'll give you this: if someone has no pension and their employer offers matching, yes, take the match first. That's free money. But after that, overpay.
And I'll give you this: if someone is on a rate above 5% and they're losing sleep over it, overpaying makes emotional sense. But for most people at current rates, the math says invest.
The math says invest, assuming you stay the course for decades, never panic sell, and reinvest every dividend. That's a lot of assumptions about human behavior.
And overpaying assumes you won't need that cash, won't face redundancy, won't want to move house. At least my approach leaves you with options.
Most lenders let you take a payment holiday if you've overpaid. That is your buffer. You've built resilience directly into the mortgage.
A payment holiday is your own money being lent back to you on their terms. An ISA is your money on your terms. There's a meaningful difference.
At the end of the day, a paid-off house is the one asset no market crash, no job loss, and no government policy change can take from you. That security compounds in ways a spreadsheet can't capture.
And at the end of the day, the tax-free wrappers the UK gives you are the most generous in the developed world. Ignoring them to chase the feeling of a zero mortgage balance is leaving real, life-changing money on the table.
The Guardian, The Optimizer, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.